Good afternoon, ladies and gentlemen. Welcome to this special episode on how the rejig at GST rates may spark a broad boost into GDP, into consumption, and then later into markets as well. We are now joined by Ms. Rumki Majumdar, economist at Deloitte India, as also Mr. Mahesh Jaising, partner and leader for the indirect tax business at Deloitte India, to discuss this very interesting cusp on which the economy stands. A very good afternoon to you both. Rumki, first to you. The Prime Minister announced from the ramparts of Red Fort on Independence Day that there's likely to be a very good deep recalibration and rejig as far as the GST rates are concerned. The topic being to fold them into 3 rates from existing 5 now. Do you think this is a good step forward? This is something that is required by the economy, something that will benefit us in the longer term?
Thank you, Mr. Bhatnagar. I think this is a very wonderful move because right now there is an increasing realization that India needs to strengthen its domestic demand. Given the uncertainty that we are seeing and the impact it might have on our trade and exports, we have to now rely more on domestic demands, especially consumption. So when we started the year, the government made a big announcements of tax exemptions, and the middle class and especially the young workforce got a huge boost in their income, which will probably have a very strong impact on consumption because their income elasticity is very high, consumption elasticity is very high. This GST will be an additional boost because now there is not only income directly, but indirect income also will increase for consumers, especially the middle class, because of the because now you have a huge segment of 12% which will fall into 5% GST regime. So consumption will be stronger, and it will definitely boost economic growth.
Okay. Ladies and gentlemen, you'll see a lot of data coming in as graphics which has been prepared by our PCR team. Lots of interesting percentages you'll see about sectors that are likely to be impacted. Let's get Mr. Mahesh Jaising into the conversation. Mahesh ji, you are the numbers man. And is this something that the industry is looking forward to you? We know some very quick winners, which is the auto space, both small car makers like Maruti, two-wheeler makers like Hero Motors, rural SUV makers like Mahindra and Mahindra. They are being rejoiced on the markets. But as a ballpark broad thrust, do you think this is good for the industry?
Absolutely. I think it's very good for the industry beyond being good. You did call out on the auto sector as one of the critical sectors, but it's also important to understand that white goods as well as cement, which is in the 28%, is expected to move to 18. And what perfect timing for this discussion. Just a short while ago, the GOM for the rates has been concluded, and some of the ministers have come out and said that they are all set and have accepted this structure. So timing wise is great. So there will be sectorial relief from a pricing standpoint for white goods as well as cement. And of course, from an aerated beverage and auto, we need to see there are different rates for those products from a point of view of cess that is there on those products. But still, if the new rate being 40, you will see a thumbs up across industry is one bucket. There's also a category of the 12% products that go down to 5, which will first give a benefit to the common man. But to me and my lens, as we proceed into the discussion, it actually gives a relief to businesses because otherwise a lot of time is being spent on is my rate here or there. And after I take a particular rate, a tax officer may have a different view. So lesser the slabs, lesser the disputes, and more better benefit for the consumers.
Okay, Rumki. Now let's look at the possible impact of this GST on government revenues. They've been buoyant over the last 3-4 years or so. The macro situation is quite good as far as India's economy is concerned. How much do you think this rejig will result in terms of a mild dip in GST for maybe 5-6 months, and then obviously volume will pick up and therefore so will tax revenues. What's your back of the envelope calculation for uh, a, a mild dip in GST?
So what we believe is that initially there will be a dip because a huge percentage of 12% goods that now will fall under 5% will probably so that revenue will come down. Similarly, the 28% which contributes to pretty much second largest chunk of the GST revenue will now become 18%. But what we believe is from it will help consumption from two parts. Sorry, revenue from two parts. One, it will boost consumption spending, so there will be more people consuming, and that will result in higher GST revenue. Second, the compliance will also improve, as our Mr. Mahesh said, that if the businesses know better where they have to file the GST, then it will all obviously will translate into better compliance, broad basing the tax revenue. All this will help in offsetting the impact. So we believe around 0.2 to 0.3% of GDP probably will get impacted by the end of this year, but it won't be as much to be if they are able to offset by increasing the consumption and improving compliance.
Fair point. And since you two are better economists than me, especially in India, the Laffer curve has worked very, very well over the last 35, 40 years. Is that you reduce taxes, compliance improves, and of course, over a period of time, the cut in taxes improves volume as well, and you get higher tax revenues. Maheshji, coming to you. What is your feedback from the industry? There has always been this overhang on GST that it's extremely, extremely complicated, and a lot of effort is, wasted in trying to make the department understand your view and understand the view of the department. Lesser number of slabs, lesser headache.
Yes, not my view, not Rumki's view, not Deloitte's view, but our participants' view. We did a GST at 8 survey, almost 960 participants, 29% being MSME. Interestingly, Shailendra, we asked for top four reforms that participants want, and rank number one was rate rationalization. Second was on
Okay.
export, working capital, and ITC, which I won't cover in great depth. But rate rationalization is something that has been on the anvil. While Rumki started off saying that we are in a important time frame where we want to push up the domestic consumption, but rate rationalization efforts have actually been on since end of September 2021, and we've seen the momentum pick up the last 12 months. So in short, this has been the number one ask from industry. Like you pointed out, there has been a fundamental debate in many products. Am I in 12 or 5, particularly on prepackaged foods, where invariably you will never get it
Chocolate
as
laced
perfect.
popcorn.
Yes, I know that's the famous or infamous example, but that will be a thing of the past. And I think the structure of the multi-rate structure is itself a recipe for potential debates like this. And I think that goes away, which keeps life a little more simple for companies to focus on their business. I do think from a business standpoint, they're very excited about this, but they also hope to be getting an inverted duty refund a little more clearer. We can talk about that as we proceed.
Little bit. Yes.
But absolutely spot on. Rate rationalization, number one ask, will help businesses to be able to have right set of pricing and not have endless years of litigation on classification.
Okay, you mentioned top four, you've mentioned two. What are the remaining two in the survey that you just talked about for
Yes.
960 individuals?
Yes, the GST at 8 survey of Deloitte said number one was rate, second was on export liberalization. So there are certain provisions that result in export. What is otherwise an export, a tax officer would take a view it's not an export. I, for one, believe that should be addressed as soon as the upcoming council meeting. But the third and fourth is in a way interlinked to pricing and working and rates. Working capital was number three, and
Okay.
fourth was ITC restrictions. And working capital effectively means that when I have a GST credit and I have more credit than the output tax, I should get my money back. So when these rates are getting reduced, there's a hope that that formula, which is there but needs a lot of refinement, that refinement also happens in one go So I'm able to comfortably pass on the reduced rates, whether it's 5 or it's 18 or whatever could be the rate for a particular product.
Okay, let's get Rumki into the conversation, and I may be skirting on thin ice here, Rumki, but I just wanted to understand one: is this GST rejig happening because of tariff problems with the US? You may not want to answer it, but let me try my luck.
So global uncertainty is definitely weighing on in the Indian economy. If you look at the fact that this geopolitical crisis, there's a whole supply chain which is getting rejigged. So we are all concerned about how this is going to impact not just our exports and trade, but also investments, capital flows. We have seen a lot of capital flight happening from all emerging countries, and India is also one of them. So so that's why the government is kind of double downing on its effort to ensure that we try to insulate our economy as much as possible from these global uncertainties and shocks. And that's why, and since we have the advantage of the fact that we have about 61% of the GDP coming from consumption, and we are expecting the private investments also to pick up. So it hasn't picked up as much as what we would have expected,
Okay.
given that there's a lot of public investments that has shouldered most of the investment so far. But and probably uncertainties are weighing on the global global investors as well as domestic investors. If we see consumption growing, and
Okay.
given the tax exemption, GST reductions, if consumption grows, I think that will give a lot of confidence to the investors to come and invest in India, and even domestic investors to prop up, because our capacity utilization is around 77, 70%, 78%.
Yes. Correct.
So we really need to build our capacity over the next few years to grow at a 7.5, 8% growth. And so I think that's where the government is kind of focusing on right now.
Okay, since you bring up consumption, Rumki, for the benefit of our viewers, I'd like both of you to put on your thinking hat. To you first, Mahesh ji, look at how the national budgets have been formed for the last three. The focus is to pump prime the economy by capex, government led capex. Now, this budget we saw the delta being shifted towards consumption via income tax cuts, now GST cuts. How do you see maybe the next one or two budgets in terms of government's focus to boost consumption, maybe via rate cuts on taxes such as GST, rate cuts on income tax? What is the medium term outlook on national budgets, keeping these two major policy changes?
No, that's a interesting question, and you very nicely put it. I will not call it an annual budget, but I'll say what is the national annual tax reform, because GST is not,
Okay.
the union budget; it's from the states as well. But keeping the language aside, it's a very critical question you ask. To me, in the medium to long term, is really what is the ask number 3 and ask number 4 of our
Survey.
survey, which is saying for ITC restrictions. So today, if I develop set up a hotel, I charge GST on the rental that you and I would pay as walk-in customers or as a thing. But when the hotel is set up, there's GST on the input side, and there's a break in credit chain. Now, there's a slight nuance to it. That is also because the real estate sector is outside the net of GST. But when there's a commercial asset being deployed and exploited, if I were to say in commercial terms, and monetized, I would say, for GST, there's a room for reviewing those ITC restrictions. So today we have, after what we are seeing is the rate rationalization exercise underway, I'm hoping all goes well, it comes through as planned. I would say the next reform will be to manage ITC credits and remove certain restrictions that are there. Some of them are very benign ask to say, why should insurance expenses by a company for its employees be denied a credit, because employees are assets of a company. Those are things that I think may happen in the short to medium term, but medium to long term would be on the ITC credits, one. Two is working capital, which I think will happen some to the extent short, some medium, some long term. So if I have an inverted duty, the press release after the Honorable Prime Minister's speech in Pillar 3 talks about ease of living, and there are three announcements there: registration, returns, and refunds. I, for one, was paying more attention to that because on the rates, yes, there's a lot of attention that we all need to pay. But that part I see as an immediate relief as a part of the package on the rate rationalization. If the refund formula gets better, it means working capital relief comes in for MSME and medium and large companies as well, because any trapped credit will indeed be money that comes back to the bank. So,
Okay.
and then in the medium to long term, I have more ideas and thoughts, not me, the participants, industry on the working capital. So, every single rupee of input credit should come back to you as long as you're not into some exempt business. Today, it is only if you're an exporter or if you have
Yeah.
a lower output rate. We are hoping that gets a little more liberalized, but that I think will take in a medium to long term.
I appreciate your modesty on uh, how you put forth suggestions via the industry, which possibly might be coming from your own desk. Let's get Rumki into the conversation. Ma'am, which side of the argument do you stand on? How do you see national budgets now maybe pivoting towards the consumer side of the balance sheet rather than the capital side, which we've seen do very well for the last maybe 7, 8 years?
Right. So I think not just fiscal, but even monetary policy is also aiming towards
Correct.
consumption that way. Yes. So I think it will continue. And if we see a sustained growth in consumption, it will bring in private capex as well, because the government has spent a lot of money in infrastructure. They might rejig the portfolio of capital investments going forward. So far, highways and roads and ports have been the focus. Now probably smart cities and energy probably could be the next like big chunk will be spent over there. I think what the government will also try to do is next year they will also kind of, if this year we see government trying to consolidate the finances even better, they will continue doing so. So that's, which means there will be some debt management rejig will happen, that the so that we ensure that our strength, our economic fundamentals improve better. I think the other one would be is, I think some difficult reforms in the in land and logistics will probably also be brought in, because we really need to improve our ease of doing business, and these add to a lot of cost to production. So I think those are some of the difficult reforms, and this is a time when the government can actually try out difficult reforms to bring in, so that there is quicker way of rebounding the economy.
Right. I won't miss the opportunity to have two very good economists and not talk about the ratings upgrade. To you, Rumki, how do you see this? A very pleasant bolt out of the blue, a ratings upgrade by S&P on the sovereign balance sheet, as also the fact that this is the best rating that we've enjoyed in 35 years. Do you see more foreign debt coming in? Do you see rupee improving? How do you see the borrowing landscape for Indian corporates change for the better because of this ratings upgrade?
It will definitely improve. I mean, given the uncertainty we are seeing, if there is a rating upgrade amid this uncertainty, that tells you what level of confidence that brings into the Indian economy. And especially at a time when your supply chains are like very fluid, and a lot of MNCs are looking at India as an investment destination, this is a very, very opportune time. Where I would see is it will definitely bring in a lot of money from the bond market. Our capital markets have done really well. And we have seen our yields like at a multi-year low levels. So it was around 6.3 a couple of weeks back. It has gone up a little, but that is we would like to see the interest rates go down further, because then borrowing costs will come down. The government will
Yes.
be able to tap into a lot of resources from outside, because we right now need resources to invest, and this could be a very good boost to investments from the and bring in more capital. Another thing is, I think a lot of money should probably start coming in into many diversified sectors, and this could be another an opportunity, because so far most of the FDIs has been into the IT and hardware, IT and IT infrastructure and energy. Now it should probably get even more diversified going forward. So this probably will be a big boost in that direction, getting
Okay.
money flows.
Okay, Mahesh, if we can get you away from the nitty gritties of tax rates, you know, the minute calculations that you keep on doing, and ask you this broad brush question: ratings upgrade, good or bad?
Very good. I think, more that Rumki says, more investment, more GST. And you did talk about, regardless of the rating upgrade, we've had consistent increase in tax revenue and buoyancy in the light of better compliance. You talked about a nice anecdotal example that whenever you've seen tax rates go down, compliance goes up. I think it is more than just fluke, obviously. There's a lot of hard work into the
Yes, yes.
what we call the e-way bill first, then e-invoicing, and then we have the e-reporting. So India is actually a poster boy to many countries who are trying to get off the ground on e-invoicing and e-reporting. So we are literally a case study as to how to do things in such a large economy and a vibrant economy. And therefore, I think better ratings, more business, more GST, and therefore the taxman will not go after many small interpretations, and they'll, let the businesses continue to do what they do best, which is doing business and giving them revenue as a customer to the government.
Okay. You know, Mahesh, I have always realized this in life, both professional and personal, that we should let the lady have the last word, and therefore the final question will go to Rumki. H2 versus H1, second half of the financial year, Rumki, how do the macro numbers plus quick estimates look to you when you look at the crystal ball against these three developments, which is a rate cut by the RBI from February so far, 100 basis points, a GST rejig, and an upgrade in the ratings?
I think I'm way more optimistic about the second half because one, a lot of uncertainty will be out of the way. Global uncertainty regarding trade tariffs and all, we will probably see where things are going that way. I think given that tax exemptions, credit group boost, and all this will start having an impact on consumption with the lag, that will also show up in the consumption data in the second half. So I'm quite optimistic the second half. Only concern would be is if suppose the global economy becomes much more turbulent, and if the US economy slows down, that might have an impact on the overall global demand and global trade. So that's the only concern. But otherwise, I think domestic demand will actually strengthen, and I'm hopeful that we should be able to get a 6.6 growth by the end of this fiscal year.
Okay, wonderful. And obviously, you know, we have that escape route which all economists follow, which is ceteris paribus, all other things remaining same. This should happen. On this lovely note, thank you so much, Rumki and Mahesh, for this wonderful discussion on GST rejig. I'm sure our viewers would have got a wonderful sense on how this rejig will help boost consumption, GDP, and of course, markets. Thank you for your time.
Thank you.
Thank you so much. Bye-bye.
That, ladies and gentlemen, was a very strong look ahead on what this GST rejig can do for us. Sakshi is ready for the last half an hour of trade, and what's really interesting in the markets is that the Nifty is now trading for the 6th day in a row in the green, 44 points higher. And I'll hand over an interesting stock to Sakshi, which is Force Motors. Maybe you should take a look at it, 21,000.
That India and Russia have nurtured one of the steady